Hello and welcome to this session in which we will explain the concept of bond ratings. What does it mean you are rating bonds? Well, every time there's a concept and I can relate this concept to a personal analogy, I would rather start with that personal analogy. As a person, as an individual, we have something called the credit score. What is a credit score for an individual? For example, in the US, the maximum credit score is 850. So the higher your credit score, the more credit worthy you are. What does it mean, credit worthy? It means if you go to borrow money from the bank, if you have a score close to 850, let's assume you have a score of 830, you will get low interest. When you get a loan, you get a low interest. Why? Because you have a low risk. Well, you also can get obviously more money if you have less risk and at a cheaper rate. Now, as your credit score goes down, for example, 600, what's going to happen? First, there's a chance you may not get the loan. Two, if you get the loan, you're going to have to pay high interest. So if you are, let's assume 600 is considered, I would say, maybe fair. 600 is fair, but 830 is considered excellent. And there's a number. For example, if your score is 830 is your excellent. If your score is 710, you're good. If your score in the 600, it's fair. I'm just giving a rough estimate. Now it's below 600 is you are poor or very poor. It means your credit score poor and very poor. And very poor and poor, usually you can get a loan from the traditional banks. You have to go to discount lenders and they charge you even more higher interest rate and they ruin your credit. But that's not the point. The point is there is a merit for your credit worthiness. There's a score. Same thing for companies. When companies wants to borrow money, they don't have a credit score. They have something called credit rating. But think of it as the same thing as a personal credit. Now, you might be asking who and how this score is determined, like if you have 830 or 600 or 400. Well, it's based on your past history. When you get a loan, when you open your credit card, when you have a car payment, when you have a mortgage, all these payments are reported to a central place. There's a company called FICO. They would collect all this information. There's other rating companies, but FICO is one of them, and they would rate you if you are making your payment on time, you are not late, your credit score will go higher. If you are late on your payments and if you default on certain loans, then your score will be lower. So this is how it happens for personal. For companies, it's the same thing. Bond ratings are evaluation of the credit worthiness of the debt issued by companies or government. Just like companies have a credit rating, the government are subject to the credit rating, whether it's a US government, state government, or even a local government. So these ratings estimate the likelihood that a bond issuer, whether it's a company or a government, they're trying to borrow money, will be able to meet their debt obligation. Remember in the prior session, we talked about the default risk, and we say, well, we have to take into account the default risk. How do we look at the default risk? We look at the company's credit rating. Specifically, whether the company can pay their interest and on time and repay their principal upon maturity. So the credit rating is important. Now we're going to talk about who assigned those credit rating and briefly how do they assign it and why is it important for a company to have a good credit rating. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
So the first thing is, who determines this credit bond rating for companies? I told you for your personal, there's companies that review your payment system. For bonds, there are two dominant agencies, Moody's Investor and S&P, Standards & Poor's. And those are very, very powerful. There are other smaller ones, but those usually what people look at. Okay, each agency use slightly different rating scales, but their ratings serve the same purpose, which is to do what? Is to help you understand the risk of a default. So rather than you going every time you want to lend money to a company, so let's think about the company. Let's think about it. Why do Moody's and S&P exist? Think about a company. The company wants to sell bonds. You're interested, we have people here who are interested in buying those bonds. But what do they have to know first? They have to know how creditworthy is that company. What can they do? Well, they can go and they hire someone to make this study for them, or they can study it themselves. Well, if they study it themselves, they may not know what they're doing, and if they hire someone, they have to pay money for that someone. So what would the company do as a result? The company would go to these companies, Moody's or Standard & Poor's, and tell them, look, we want to sell bonds and we want to make it fair and easy for investors to invest in us. So give us a grade, a rating, a grade. So what's happened is we'll give them a rating. These companies will give them a rating and the people will trust these ratings. Now, can we always trust these ratings? And the answer is no. Most of the time, 99% of the time, you can trust the ratings. Sometimes you should not trust these ratings. A case in point is the 2008 financial crisis. During the 2008 financial crisis, Moody's and the S&P gave many bonds good ratings, which we're going to see what it is. It's AAA. And what we find out later, those ratings should not have been given to these companies, and as a result those bonds defaulted. So yes, these ratings are reliable, they should be reliable, but at the end of the day, use your judgment. And we have two major bond rating categories. They fall into two major. The first one is investment grade. An investment grade is basically good. They are considered low risk, and they would include the following high grade. For example, Moody would say AAA, capital A, lowercase aa, then A, then small a. S&P, they triple capital A, double A, same thing, but they use different grades. So if you see triple A, you'd know this is an S&P. If you say a capital A and two double A's, this is Moody's rating. So basically, let's call it triple A. Then double A is worse than triple A, and A is worse than double A. Then we have, if you have a triple A, this is the best. These issuers are seen as extremely or very strong in meeting their debt obligation. I don't know what the US government is. It was always AAA, then it moves to AA, I believe, but I could be wrong. But these ratings will change anyway, I have to tell you at the end. Medium grade are A, single A, triple B, then we have double B, a B. So those are medium grade companies. These bonds are still investment grade. They are part of the investment grade, but the issuer may face challenges if economic conditions worsen. And you could be a double A and move from double A to an A, or you could be an A, move from double A to triple B, or you can be an A and move to double A, and you could be a double A and move to a triple A. This is one group of category, investment grade. That's the first one. Then we have non-investment grade, which are called speculative or even junk bonds. Well, these are riskier bond with high chance of default. The ratings is once you go into double B, B, triple C, double C, C, we're looking at what type of investment? Non-investment grade, speculative or junk. The issuers may already are under pressure, not under financial stress, and they're vulnerable in case they face any financial challenges down the road. So, and we have a default rating. S&P is D rating. This means this company might default, and Moody's C rating indicate the bond is in default. So if you say C, C and D, those are no good. Okay, so C and D's are in default. In default means what? It means you are in default right now. You're not paying your interest, you are not paying your principal, and you are in default. And this is an example from the real world. Now, keep in mind, you're looking at this, you might look up Green Core Energy, and you might say, well, it's no longer AAA, it's AA. Yeah, it could change. But for now, when I pull this, we can say, for example, Moody's, they are both rating Greencore Energy, a global utility company with over 10 billion in cash reserve and stable cash flow, hold a AAA rating due to its low debt and dominant market position. AAA means what? They have a strong capacity to meet financial obligation. They're a high investment grade. Then we have to give you an example of AA, Delta Health System. Again, very strong but slightly less secure than AAA. Has consistently strong earnings and moderate debt, earning it AA rating. Now, Delta Health System might drop to an A, might drop to a triple B, or it might go up to a triple A. This could change. What would change it? If they make more profit, if they have a stronger market position, so on and so forth. So why would it make a difference? So let's assume the AAA company wants to borrow $1 million and the AA company wants to also borrow $1 million. Given everything else the same, for example, AAA would only have to pay 5% and the AA company will have to pay, I'm just making this number up, 6%. The point is, Delta Health System, generally speaking, will pay more to borrow money than Greencore Energy. Then if we go down, let's go down to Vision One Biotech, a startup with no approved product and heavy R&D expenses, is rated triple C AA or triple C. It struggled to raise capital and faces default rate. If this company wants to borrow money and someone is interested in selling it, in selling, buying their bond, they might charge them 20%. It means the cost of raising money for Vision One Biotech is way higher than Quick Mart Express, Quick Ocean Airways, and you get the point. The lower your credit rating, the more you have to pay, let alone no one will give you money sometimes. Just, I'm sorry, it's too risky. You will not find interested people in buying your debt. So that's why bond rating is important, ranging from AAA down to AD. Think of it as your grade. think of it as your grade. If you have a better grade, you'll have a better job or better earnings. When you have a lower grade, you may not get a job, and if you get a job, it's not the best. Now, ratings are not permanent, as I just mentioned earlier. Ratings could change, can be upgraded. Obviously, it's better, so you can go from good to excellent, or they can be downgraded. You can go good to fair to poor to very poor, depending on the issuer performance and financial health. So how these S&P and Moody's will determine this? They would look at your financial record, how well or not well you are doing. How's your cash flow? So credit agency also release what they called outlook. So before they change it, they would say their outlook is positive or stable or negative, and may place companies on watch for potential changes. So they will warn you ahead of time. Sometimes they don't. Sometimes the situation is very bad. The company is discovered to be doing fraud, then they have to change it immediately. But sometimes they put you on a watch, say that you are on a watch, or outlook, release outlook. This is AA and the outlook is positive. It could be AA and the outlook is stable. Again, I should have looked up the US government right now, US federal government. I believe they are AA and stable. Outlook is stable or positive. But it's something you can do on your own if you're interested. So remember, a default doesn't always mean that a total loss, because companies could go into default and they could restructure and still make some payments. So bond ratings is very important to understand when it comes to bonds, because bond ratings determine what? Determine the attractiveness of the bond, determine the interest rate that the company must pay, determine how much the investor is willing to pay for that bond. The worse your bond rating, the lower the amount that the investor wants to pay, because they're taking risk. When you're buying something and it's risky, you want to pay low amount for it because you're taking risk. So that's the importance of it. Let's take a look at this question from farhatlectures.com. What's the most likely impact of this downgrade? So we have TechPlanet recently had its credit rating downgraded by S&P from BBB to BB. The company has 500 million in outstanding bonds. What's the most likely impact? Bond prices will rise due to the increased yield attractiveness. Well, no, the yield would go up. You want to yield more, but the bond prices will go down, because now you want to earn more, you'll pay less for the bond. Therefore, A is out, because the time value of money. The bonds are now considered investment grade. No, they were investment grade. They go from investment to non-investment to BB. Investors may demand a higher yield due to the increase in risk. Is this correct? Yes. Did risk go up? Yes. Going from BBB to BB What happened? Your risk went up. As your risk goes up, your yield, you want to earn more. Therefore, the investor may demand a higher yield due to the increased risk. Tech Planet will automatically default on its debt. No, it's not going to automatically default. Going from triple B to B, yes, you're going from investment to non-investment grade. Nevertheless, you are still in decent shape, but you want to shape up better. What should you do? Whether you are an accounting student, finance students, studying for your CPA, CMA exam, any sort of a professional certification, go to farhatlectures.com. Look at additional resources. The best investment you can make is investing in yourself. Good luck, study hard, and of course, stay safe.